It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today again is Michael Becker.
Hey, Paul.
Smartest guy in the room. Smartest guy because he's purchased over almost $500 million in apartments in the Dallas-Fort Worth area. As a principal, the guy owns, 4,600 doors?
Yep.
And so if he times 2 parking spaces per door, he owns, 9,000 plus doors? Spaces?
Parking spaces? Yeah, something like that. Yeah, we got a lot of that. I was trying to figure out how many people live on our property. It's thousands and thousands of people live on our properties. It's nutty.
That really is amazing. You really have a little city that you are the mayor of.
We do, the mayor of Beckertown. That's right. Yeah.
So recently, we just had the Feds move their interest rates about 0.25%. And so the question that came on for Ask Mike Monday is, will a Fed rate hike have an impact on commercial real estate?
Yes and no. So they raised the rates. We're recording this on a Friday, so on Wednesday they raised the rates, and then the 10-year Treasury went down. So that's certainly in the short run, it made everything cheaper to borrow money if you in the apartment business, where most of the loans are priced off 10-year Treasury plus a spread. So I'm certainly no expert economist here, so take this with a grain of salt. But it seems that the market isn't believing that the economy is on quite as much fire as Janet Yellen's trying to front and portray that it is. So the market's kind of discounting what she's doing in the long term. So what I'm seeing is that yield curve between the short-term rates and the 10-year Treasury is getting flatter and flatter, meaning that I think it's somewhere around 80 basis points as we sit today between the 2-year Treasury and the 10-year Treasury. So you only get 0.8% higher going out an additional 8 years. So that kind of tells the market's expectations of future inflation and pricing and futures interest rates that they're willing to take only a small amount of money or a small amount of yield difference for that extra 8 years worth of tying your money up. So it seems that it should have a negligible impact on the commercial real estate pricing. Certainly 10 years, as long as 10-year Treasury stays in check, everything should be okay. You had Dr. Dotzauer out, Paul, if you remember. He was talking about this, a month or two ago when he was at the Old Capital Speaker Series, and Dotzauer was saying the only thing that's going to make the 10-year Treasury go up is the expectation of inflation. So it just seems that, the market is not expecting inflation and pricings, and the 10-year Treasury is reflecting that. So the answer is I'm certainly no expert, but it doesn't seem to have any material impact on multifamily industry because most of that is going to be priced off the 10-year Treasury.
So I'm going to say 2 things. One, most multifamily properties are based on the 10-year Treasury to determine what the interest rate is. We take the 10-year Treasury, we add in the profit spread, and that equals your cost of borrowing that money. So if the Treasuries have gone down, your overall cost has gone down. But I will say on the banking side, interest rates have gone up recently. So even if we have a 0.25% rise, we're seeing banking rates instead of 4.75 to borrow, now they're up at 5.25%. So that is one thing that banks love to increase rates fast. They have difficulties trying to bring them down as low as they should be to the market. So with this rise of interest rates, yes, it's going to affect bank balance sheet portfolio lending, but it's not going to affect large multifamily non-recourse Fannie Mae, Freddie Mac, CMBS loans that are currently out there.
So how do the community banks, Paul, price their loans versus the 10? So the Fannie Mae, Freddie Mac, CMBS, kind of the securitized world price it off the Treasury plus the spread. How does Joe Smo Community Bank price their debt? Is it on LIBOR Prime? What do they do?
It's whatever they can get away with to the market because they're getting their money at the same place. They're usually using the short-term borrowings to do the long-term lending on. And so they're trying to figure out, whatever their cost of funds is, plus the G&A, plus their reserves, plus everything that's added into that equation. And then they're just saying what the market is. So right now the market, kind of across the United States for commercial real estate, say bridge lending, is anywhere from 4.75% up to say 5.25%, 5.5%. So we've seen that rise in the last year or so since the Feds have been keeping an eye on trying to keep the rates going up.
It's good. Has there been any other impacts that you see? You do a lot more lending than I do anymore with what the community bankers' appetite is or kind of the general sentiment? Are they having any other pressures at the local community banks that you hear?
The buckets are still pretty open. Sometimes you hear about commercial real estate. The bucket is full, and then they have to break it down to: is it multifamily full, or is it office full, is it retail full? Pretty much everything is wide open right now. But there are some banks that are just not real estate lenders, and so their bucket will never be open. So you got to find, when you're out shopping for a loan, hopefully you call Old Capital. But if you don't and you talk to your local banker, just make sure that, see if their bucket is full or it's empty, that they have the capacity to do a multifamily property. Like we've talked about before, some lenders just don't like multifamily. They don't like older properties. They don't like the property that you want to buy in. Ask that lender, when's the last time they closed a multifamily loan of the similar age that you'd be looking for?
Have you heard any feedback or chatter about the banking regulation and kind of maybe the potential appeal of Dodd-Frank? Has they functionally done anything different with that chatter?
It has not happened on the local level. It's happened more in the boardroom of just the lowering of regulation piece. You have a lot of bank presidents and bank auditors, internal bank auditors, that don't want to create all these new forms. They don't have the personnel or the money to do all these additional forms that Dodd-Frank has asked them to continue to do. So if this thing gets overhauled and remains overhauled, you'll have a lot of happy community bankers out there.
Oh, good. What else is going on, Paul? What's when people want to find out more about us, where can they go?
Just make sure that you go onto the Old Capital Podcast website, website, and that is the one that gives you the 15-page white paper report that you can sign up and get. It also lets you know if there's anything that's coming on to the Old Capital Speaker Series. One of the things that we've talked about is going on to Facebook Live. I think we're going to start doing in the fall some of our speaker series events on Facebook Live. And so you can kind of figure out if you're in New Jersey or Florida or Chicago that you want to kind of keep up with what's going on. And you can kind of be part of the crowd and listen and watch. We'll let you know when Facebook Live is going to be available.
So yeah, definitely go to Facebook, search the Old Capital Real Estate Investing Podcast or Old Capital. We have 2 different Facebook pages. Kind of follow and like those Facebook pages, and keep current events up there as well.
We appreciate everybody's time. Thanks for listening. Again, Michael Becker, smartest guy in the room. I'm Paul Peebles. Thank you.